Here's a situation that plays out more often than people admit. Someone in their early 30s doing everything right, maxing their 401k, investing consistently, not panic selling, looks at their portfolio after 5 years and realizes something uncomfortable. They own 17 different funds, overlapping exposures everywhere, 3 separate S&P 500 funds spread across 3 different accounts, international exposure they can barely name, a target date fund added years ago because that's what HR recommended. It's not a bad portfolio, but it's not a system, and there's a difference. The investors who actually reach early retirement, the ones who stop working in their 40s, sometimes their 30s, tend to share something. Not necessarily higher returns, not necessarily more money saved, they have simplicity. 5 funds, or close to it, working together with clear intention. Today, we're going to look at those 5 building blocks, not just what they are, but what role each one actually plays and why the combination matters more than any individual choice. Before we look at specific tickers, here's the thing most investing content gets backwards. People treat ETF selection like a performance contest. Which fund had the best 10-year return? Which has the lowest fee? Which name do I recognize? But a retirement portfolio isn't a collection of individual performers. It's a system, and systems are evaluated differently. The right question isn't which ETF performed best. The right question is, what role does each fund actually play, and do those roles work together? With that framing, let's go through the 5 building blocks. Fund 1, VTI, the engine. Every portfolio built for long-term growth needs an engine, something that captures broad economic expansion over decades and just keeps compounding. For most FIRE investors, that's VTI, the Vanguard Total Stock Market, ETF. VTI holds roughly 3,500 U.S. companies, not just the household names, Apple, Microsoft, Nvidia, but thousands of smaller businesses most people couldn't identify. Mid-caps, small caps, companies that are growing fast but haven't made it into the S&P 500 yet. The expense ratio is 0.03%. That's $3 per year on every $10,000 invested. Essentially invisible. You might wonder why not just hold VOO, the S&P 500 fund? It's a fair question. The honest answer is they're very similar. By weight, the S&P 500 accounts for roughly 82% of VTI's portfolio. So, the 2 funds move nearly in lockstep. The main difference is that VTI also captures several thousand smaller companies the S&P 500 excludes. Some of the strongest performers of the past decade weren't in that index at the start of it. It's a subtle edge, but it's there. This is the core. In almost every early retirement portfolio, VTI does the heaviest lifting over time. Fund 2, VXUS, the global layer. Here's a question worth sitting with. If you'd held only US stocks for the past 15 years, you'd have done extraordinarily well, better than most international markets. So, why bother with global exposure at all? Because markets run in cycles, and those cycles are longer than most people expect. From 2000 to 2010, the so-called lost decade for U.S. stocks, international equities outperformed the U.S. by a wide margin. The MSCI ACWI ex-US index returned over 70% that decade, while the S&P 500 returned roughly 15%. The decade before that, the U.S. led. And as of 2025 and into 2026, international stocks have again been outpacing the U.S. by a meaningful margin. Nobody knows with confidence which cycle is just beginning. VXUS, Vanguard's Total International Stock ETF, holds over 8,000 companies across developed and emerging markets outside the US, Europe, Asia, Latin America, the portions of the global economy that VTI simply doesn't reach. The fee is 0.05%. This isn't about chasing better returns. It's about not being completely wrong if the US enters a prolonged downturn. Every durable portfolio has some form of insurance. VXUS is this one's geographic insurance. It won't always be the top performer, but when the US stumbles, this is what keeps a portfolio from falling in one direction all at once. Fund 3, QQQM, the accelerator. Now we move into territory where the risk profile starts to shift. If VTI is the engine, QQQM is the turbocharger. It tracks the NASDAQ 100, the 100 largest non-financial companies on the NASDAQ exchange, heavily concentrated in technology and innovation, the companies building AI infrastructure, cloud platforms, biotech, and the next generation of software. Why QQQM and not QQQ? They track the identical index, identical holdings. The difference is cost. QQQM charges 0.15% versus QQQ's 0.18%. That gap used to be larger. QQQ converted from a legacy structure to a modern ETF format in late 2025, which cut its fee from 0.20% to 0.18%. But QQQM is still cheaper, and for a long-term buy-and-hold investor who doesn't need QQQ's extreme liquidity for trading, QQQM remains the more cost-efficient choice. Here's the honest trade-off. QQQM has dramatically outpaced the broader market during technology bull runs. It's also fallen significantly harder during corrections. In 2022, the broader market dropped roughly 18%. QQQ and QQQQM, tracking the same index, fell closer to 32 to 33%. The same concentration that drives outperformance on the way up amplifies losses on the way down. This is an accelerator, not a foundation. At 10 to 15% of a portfolio, it can meaningfully tilt returns toward higher growth without becoming a single point of failure. At 50%, you're no longer diversified. You're making a sectoral bet. That's a subtle difference, but it changes everything. Fund 4, FBTC, the asymmetric bet. This is the one most people have the strongest reaction to in both directions. FBTC is Fidelity's spot Bitcoin ETF, and before forming an opinion, it's worth understanding precisely what role this plays. Bitcoin is not a traditional investment. It has no earnings, no dividends, no cash flows to model. Its price has been cut in half multiple times. It could go to zero. That remains a real possibility. It has also outperformed virtually every other major asset class over the past decade. The institutional picture has shifted meaningfully. In March 2025, the U.S. government established an official strategic Bitcoin reserve by executive order, formally designating over 200,000 Bitcoin as a national asset rather than selling it. Major institutions, pension funds, endowments, corporate treasuries now hold Bitcoin ETF positions at scale. That doesn't make Bitcoin safe, but it does change what fringe asset means. For some long-term investors, a small allocation, say 5 to 7%, represents what's called an asymmetric bet. The logic, if that slice goes to zero, it's painful, but the portfolio survives. It isn't a retirement-ending event. But if Bitcoin's trajectory continues as institutional adoption deepens, even a small position could meaningfully impact total returns over 20 or 30 years. Why FBTC specifically? Fidelity self-custodies the underlying Bitcoin through its own digital assets division, not a third-party exchange. The fee is 0.25%, which is competitive within the spot Bitcoin ETF category. Fund 5, BND, the anchor. This is the fund most aggressive investors want to skip, and for very long time horizons, some financial plans support that choice. But here's what the behavioral data consistently shows. When portfolios drop 30%, 40%, 50%, which happens, the majority of investors don't hold. They sell, sometimes at exactly the wrong moment. And that single decision, panic selling during a crash, does more damage to long-term returns than almost any other factor. More than fees, more than fund selection. BND, Vanguard's total bond market ETF, now holds approximately 17,350 securities, government treasuries, corporate bonds, mortgage-backed securities. The fee is 0.03%, matching VTI. Bonds don't produce exciting returns. Historically, the U.S. aggregate bond index has averaged roughly 4 to 5% annually over the long run. That barely outpaces inflation. But the real reason bonds exist in a portfolio is stability. And here, it's important to be precise about what that means. In most equity bear markets, 2008-2020, bonds held their value or rose while stocks fell. That's the behavior most investors picture when they think about diversification. However, 2022 was a different and important exception. When the Federal Reserve raised interest rates aggressively to fight inflation, both stocks and bonds fell simultaneously. BND dropped roughly 13% that year. This doesn't mean bonds are unreliable. It means bonds are a hedge against equity crashes driven by fear and recession, not necessarily against rate-driven sell-offs. That distinction matters, and any honest assessment of BND's role has to include it. With that context, bonds remain the shock absorber for the most common types of market stress, and they reduce the chance that a portfolio enters true free fall during the kinds of crashes that push investors to make irreversible emotional decisions. For a 25-year-old with 4 decades ahead, a bond allocation of 0 may be completely reasonable. For someone a decade from retirement who knows their own behavior under stress, a meaningful bond allocation could be the difference between holding through a crash and abandoning the plan. The 5 funds aren't a fixed recipe, they're ingredients, and the proportion depends on one thing more than almost anything else. How much volatility can you honestly tolerate without doing something you'll regret? Aggressive mix. For investors in their 20s or 30s with high risk tolerance and long-time horizons, 50% VTI, 20% VXUS, 15% QQQM, 15% FBTC, 0% BND, pure growth, no cushion. This portfolio will fall hard during corrections. The underlying bet is that decades of compounding justify riding those drawdowns out. Balanced mix. For investors who want meaningful growth but need to sleep at night, 45% VTI, 20% VXUS, 10% QQQM, 10% FBTC, 15% BND. Still equity heavy, still tilted toward growth, but with enough of a bond cushion to dampen the worst swings and reduce the chance of a panic-driven mistake. Conservative mix. For investors who know themselves and know they'd panic in a severe crash. 40% VTI, 20% VXUS, 0% QQQM, 0% FBTC, 40% BND. Simple, durable, a slower path to early retirement, but one with far less risk of a catastrophic behavioral error derailing it. Notice what stays constant across all three. VTI and VXUS are always present. The core doesn't change. What changes is the degree of acceleration and the size of the anchor. That's the real decision, not which 5 funds to pick. How much risk can you honestly handle? Not in theory, but when a red screen tells you your portfolio is down $80,000 in a month. The 5 funds we covered today aren't a secret. They're not a loophole. They're a framework built on an idea that's been proven across decades of data. Simplicity, consistency, and low cost outperform complexity over long periods. The hardest part of early retirement isn't choosing the right allocation. It's keeping your hands off it when the market makes that feel impossible. That's the real skill, not the tickers, the temperament,